Hello, everybody. Thank you for joining us for today's public webinar. As you know, we do have a live intensive that starts on February 21st. On our website, if you're new, please just go to jimdaltontrading.com. You can go to courses. Just a couple other things I'll just point out here. If you don't follow us on X, you can find our official link to our X account over here. YouTube channel, we do release a weekly week ahead video. You can find that right here. And if you don't already subscribe to our emails, you can do that right here under this black strip right there. But go to courses and you'll see that the intensive is featured up at the top. If you are new to us and you're like, what is this all about? You can find the details here, or you can scroll down and go to the view detail of each course or product that we have available. Right now, we do have limited discounted bundles for purchasing more than one course because of the intensive. You do need to have the foundation and application of the market profile e-course as a prerequisite. So that's why we're offering a discounted bundle right now. They won't be available that much longer because we know that people won't be able to complete the prerequisite requirement if it's too close to the start date of the intensive. So these are limited time bundles that will be available for, I think maybe another couple of weeks. All of the webinars of our live courses are recorded so that you can go back and review them. Specifically for the intensive, you've got 1 year to review all the materials so that you've got enough time, or in case you've got a day job, whatever the reason may be, we do record all the webinars so that you can go back and review them for a year. And this is the schedule. These times are posted in Eastern, but you can see here that we do have special presentations and things that we will be covering each week. So if you need to download the schedule because you're curious, you can go and do that. You can see the blue link right here with regards to the intensive. Okay, Jim, Jim, are you there? Good morning.
Yes, I am. Yes.
Okay, just making sure. Somebody mentioned something about audio. Is anybody else having audio issues? If you could type in and let me know. No, okay. Yeah, it seems like it's if you're having an audio issue, you may need to exit and come back in to resolve the issue. Okay. Okay, so Jim, you said that you wanted to replay part of yesterday?
Yeah, I want to, but before, bring it up to get ready to replay yesterday morning, but don't replay it yet.
Okay.
Let me give some background first. Starting on last Friday, there has been very unusual selling, futures selling near the high for the day. If you look at last Friday and point out that high up there, Jen, and you'll see how close that last Friday's high is to the high for last year. So you move over. So can you show last year's high, please?
Do you have the number for that? Are you talking about the 4840?
No, it's the red line. Okay, I
Yeah,
just wanted to show the profile to the left. Move over so you can see the profile on the left.
Oh, you want to see it? Okay, yeah. I didn't.
So you see there was a very strange because there was no excess on that high. So that's had my attention. Now, come back and we'll start with last Friday's high. What I wrote in the weekend report was the possibility, or what we call the week ahead. And what I said in that report is, over the years, I have not been somebody that gets highly focused on double tops and double bottoms and things of that nature, because they're all, everybody talks about that from a technical standpoint. I haven't found it to be that relevant, but I was paying attention to it this last weekend. And the reason was that there was huge futures volume at the high during a period on Friday. And with that huge futures volume, it was not able, so there was a seller there of size. Now, what I don't know, and I got a call yesterday from one of the big prime brokers, a name you would recognize, and asking, did I know who the seller was up there? Because they said they're all talking about it. And I see two possibilities. The one possibility is that there's what they call the call wall up there. You've got the monthly options expirations on the 24th. There is a tremendous number of calls up there. No calls above, like they're in the 4,800 level. And it could be that the dealers don't want to see the market go through that level because of call positions. So it's called the call wall. That's one possibility. The next possibility is that there is a real seller up there because the volume was very high and it did not take that out. That same selling continued yesterday, early morning at the high, and it continued again. I'm sorry, it goes on Tuesday and it again on yesterday. Now, what I want to do, I want to start by replaying yesterday morning, and I want to show you exactly what I'm talking about and what I'm seeing in there. Okay, so we're going to replay starting with A period yesterday morning. Okay, and you'll see that the profile is split. On the left is the, well, in the A period, they're going to be the same. But so we gapped lower yesterday. Okay, we're playing at 5 times normal speed. So notice up there, remember, it's 5 times normal speed. So you're looking up at the high yesterday and you're seeing, 6,000, 5,000. That's a lot of contracts early in the morning. So once again, that's not as high as it had been on the previous sessions, but that's pretty high volume up there that time of the morning. So that was 3 days in a row that we have seen some pretty serious futures volume, which is either because of the call wall or because that there is a larger seller. All right. I don't normally spend an awful lot of time looking at the futures volume, but as we say, everything's a series of facts surrounded by other circumstances. And the high volume 3 days in a row tells me that there's been something serious going on. There's been some really serious selling near the highs every single day. And like I say, it started last Friday when the market should have had a chance to take out the high from last year because it was a non-excess high. Now watch this market. We're coming back up. We're coming back up, testing that high again. So watch it go up there and watch the stubbornness. So again, you see there's some pretty good volume taking place up there. Every time the market tries to go higher, that's been, like I say, 3 days in a row. All right, Jen, you can stop there. I just wanted to point that out. And I wanted to say that, like I said, I got a call from one of the very serious prime brokers who usually they have pretty good information. Their question to me was, do I think it's because of the options or do I think there's a real seller? And I said, I don't know. I said, I wanted to call you and ask you because it's very unusual. Okay, Jen, let's go and.
I'll give you the screen back, or
Yes,
do you
please.
want? Okay.
No.
What?
Yes, I'll take the screen. Thank you.
Okay, you said yes and no, and I'm like, what?
No. Yes,
Which
I'll
is
take
it?
the screen.
Okay, there you go. I've given you the screen.
Okay, so one of the things that makes trading so very, very difficult, and so many times traders are looking at numbers more than anything else. The selling, particularly yesterday afternoon, was very, very slow. It's what we call tempo. You know, you have tempo in music, you have tempo in a lot of things. But tempo is something that I can't give you a definition of tempo. You have to learn tempo. But I can tell you that yesterday, throughout the day, as the market tried to move lower yesterday, the tempo was very, very slow. Prices, if you're only following prices, the prices look really weak. And the market looked like it was going down and was testing. Here's what I was looking at. Here's what I think the markets, this is my real serious reference down here, is the 4720 level, which was the low on the last, I think that's the low on the last FOMC day, if I remember correctly. And so what you see is since that period of time, we had a lot of rally, very thin. Notice how thin this was, which is usually a sign of very emotional selling. And of course that continues, but there's been no follow through to that. Very emotional, short-term buying, but no follow through to that. And we were down there testing that low yesterday, but the tempo and the volume was very, very slow. And that, what happens, the reason I'm spending so much time on tempo here is, like I say, I can't give you a definition of it. I can tell you it's slow. It's going to be relative to what else you've seen in the market over a long period of time. But it is a very important observation because it told me that the risk of being short was huge. One of the things that so many times, and I don't know if you all remember, but I had memberships on both the Chicago Board of Trade and the Chicago Board Options Exchange, while it was many, many years ago. But one of the things that you learn on the floor, so many times, short-term, and this is particularly aimed at short-term traders. So many times, short-term traders think of risk in terms of price. Risk to a short-term trader, and particularly if you were a short-term trader on the floor, was not in terms of price. It was in terms of the aggressiveness of the bids and the offers. For example, if a market was going lower and the offers were increasing, the short-term traders on the floor knew they could go short and their risk was very limited. The same time, if prices were going lower and the offers were drying up, then the risk was increasing substantially. Consequently, if the bids were strong in the market, the risk, if the market's starting to go up and the bids are strong, price has nothing to do with it in the minds of a short-term trader. If the bids are strong, the market's going higher. I saw many cases on the floor where there were traders that were very small traders. Maybe they were 5-lot traders. And all of a sudden, when the bids came in and the markets were strong because of bidding, they became 20 and 25-lot traders. So many times where we err as short-term traders, we think of risk in terms of price. What I'm trying to get to you is that the bids and the offers, but I don't look at things like footprint for any of that because a lot of it doesn't show. But what really is I think the most important thing to me as a short-term trader to evaluate risk is tempo. Tempo is the speed. Yesterday afternoon, the market was going lower, the tempo was absolutely terrible. So what if the market's going lower and the tempo is slow? What does that tell me? That tells me that the odds are that the offers are weak. So if this market was going down, and particularly it was trying to come down again in L and M period, very slow, it tells me the offers are weak. And that tells you that the risk of being short is very large. Okay, questions on what I've talked about so far?
Okay. When you talk about because of the call wall, are you referring to someone hedging against a long call?
I don't think it's someone. I think it's probably dealers. And I don't know who it is, but I know there's an awful lot of calls up there. And a lot of times they don't want those calls to be exercised up there. And they will take, sometimes the dealers, may sell into it. I don't know. We're talking about speculation, but anybody knows, and professional traders know there's a call wall up there. They know there's a tremendous amount of calls up there between the 48 and 4,900 level. And they would just as soon not see it go much through that. Okay, what else? Jen, you got any questions?
Yes. About tempo, is it possible that the market is waiting for some event?
As a short-term trader, I mean, that's always possible. The market's always waiting for some event. But I think that kind of thinking as a short-term trader, remember, this is oriented toward short-term traders, will get you in trouble. When the market's coming down here as a short-term daytime frame trader, and that's where I specialize, when this tempo is so slow down here, and it's so easy to get distracted because you're watching price go down, and I felt it. I mean, it was tearing me apart because I wanted it to go lower. I wanted to go down and get to that low from Fed Day. But I'm watching this and the tempo is just unbelievably slow. And what's that telling me is, yes, price is going lower, but as price goes lower, the offers are drying up. And when price is going lower and the offers are drying up, you are dealing with a substantial risk. And of course, that's what materialized in M period. Now, there's two things that take place in M period. Remember, there is an awful lot of short-term traders that are not allowed to take positions home overnight because their broker dealer won't let them because they're undercapitalized in there. So what happens as this market's going down, these short-term traders have a tendency to hang on and hang on and hang on. Well, and at the last minute, because they have to be out by the close, at the last minute, all of a sudden, this panic to cover takes over. Well, guess what? At that point in time, late in the day, nobody's going to sell it to them. So you get this huge run in M period, which is more than likely nothing more than short covering from traders that were trying to take the market lower late in the day. And the market had been going lower all day long. And so, they're in there saying, oh boy, greed steps in. But that late in the day, they're in trouble. If they have to cover, nobody's going to be there to help them out. Not that late. Okay, what else we got?
Okay, would looking at the volume profile of each 30-minute TPO help to understand tempo?
No, I don't think so. Tempo, I think tempo is understand you're watching the market. You're feeling the market. So many times people want to look at things to get answers. Feeling. So much of the market has to do with feeling and intuition. When you're watching this market go down, it was just slow as can be yesterday. Really slow. Okay, what else?
Okay. What's holding the market up when the advanced decline appears to be crashing?
I don't know. It's you look at the market. I look at the market and I'm saying, what's going on with this market right now. And I'm looking so much this, I'm not looking at other factors. I don't look at other market sentiment things. I'm looking at this market because this is the market I'm trading. Okay, what else?
Okay. Wouldn't you say that we're in a 100-point balance between approximately 47.40 and 48.40?
But so what? As a short-term trader, you know, what I'm looking, what's going through my head, the market, the last big move in the market started with the FOMC meeting. And so you got all this emotion on the 8th, all this emotion. And of course, it's momentum trading and it feeds on itself. But you couldn't get any real follow through. You got a new high for the year, but you couldn't get any follow through from that. So there's a tremendous amount of long positions in the market, and everybody's oriented towards that. But the longer that goes without getting satisfaction, you say, the majority of people that are still profitable following Fed Day is thinning out. And the more the market stays under the pressure, the more you increase the odds of liquidation. And as I've said for a long time, the underlying structure of this market is very poor. Now, and I do also look, you've got a lot of confusion going on with the Fed. Everybody just took it for granted and probably got ahead of themselves. Well, now some of the numbers aren't coming in quite to support what everybody wishes would happen. But what I do is we can talk about all those things. Those kind of things, many times we'll do a short-term trader in. As a short-term trader, the information you're concerned with is the market. The NASDAQ trading different than the ES in there. You've got different stocks, different makeups in the market. If I'm trading the ES right now, I'm sitting there saying the trend is down, and there has been a large seller for whether it's options or whether it's a real, position seller, been going on since last Friday. And until that's over, I want to be very careful. So now, what are we dealing with today? Yesterday, we gapped lower. We had no excess on the high. Now we've gapped higher. So the gap trading guidelines are applicable this morning. And the gap trading guidelines are as follows. Go with all gaps that aren't filled fairly quickly. And no, I can't define fairly quickly. But if this market attempts, the best buying opportunity is if the market attempts to fill the gap and is unable to do it. If the market fills the gap, then the next thing you look at is the value. Can you get into the value area? And at a minimum, can you get value overlapping to yesterday? So if the gap is not filled, you go to the long side. If the gap is then filled, you focus on developing value. If value cannot develop to at least overlapping, the odds of a late rally have increased substantially. Okay, couple of final questions, Jen?
Yes, there are several. Okay. For the call wall, would that mean that the possibility exists for it to disappear after this Friday's expiration?
No, I think it's monthly. And I just think the monthly expiration, I think, is the 24th.
Okay.
I think there's more, I don't know for sure, but I think there's more monthly calls than anything.
Okay. With regards to tempo, since you were talking about tempo earlier, slow tempo is a caution for shorts, but what's your take on using that as a single observation for looking for a short-term rally?
No, it's a piece. It's a piece. Remember, everything's a series of facts surrounded by other circumstances. Now, when the market's going down yesterday and tempo is slow, there's two messages in slow tempo. The first message is your risk of going short is getting very high. The second message is the odds of a short covering rally are increasing. Do not confuse. Don't try and make one message out of it. As a trader, remember, if you're short, the market's going down. If price is going down, we have a tendency to overstay. Oh, we're making money. Well, but we do a very poor job a lot of times of understanding that the odds are building against us. So slow tempo on the downside tells you that the risk of being short is increasing. That's one. The second factor is the risk of a short covering rally have increased substantially. All right, before I sign off, remember we're coming up to the intensive starting February 21st. This will be quite different than any other intensive we've ever given. And the reason for it being is something I thought I'd never do again, but I'm writing another book. It's kind of a legacy book or a sequel to Mind Over Markets and Markets in Profile, reevaluating everything we've ever looked at. And obviously, when we first came out with the market profile in the 70s, it was like new technology. Well, guess what? With any technology, there's change and there's evolution. Things have changed. Additionally, when it first came out, both of us learned. Clients learned, and I learned from talking to all of you. So a lot of that's going to also be in the book, but that information, because I'm rethinking everything as I write this book, that will be incorporated also into the coming intensive. So I think it's going to be a really superb intensive. Jen, one final question.
Okay. Somebody's asking, in Jim's experience, if the market is pushing very hard to tag a reference point but fails over and over again, what is likely to happen?
You know what's going to happen. The more attempts and can't get it, then you increase the odds of a short covering rally. One of the things that I'd like to talk about very briefly, and it's in the book, is one of the things that gets traders in trouble is when they have targets. We brought up the word target. Target has done a lot of traders in. They get focused on that target, and they negate to evaluate the other information that's right out in front of them because they're so focused on the target. All right, let me say thank you very much. I hope you consider some of our educational programs. Have a great trading day.
Thank you. And just remember, our limited time discounted bundles are only available for another 2 or 3 weeks. If you have any questions about what's right for you, or you've got specific questions on our courses, by all means, contact us at Dalton@jimdaltontrading.com or give us a phone call at the bottom of our website. Thank you so much. Have a great week, everybody.